So this is a huge systemic problem. That said, capitalism is a great thing. It has a way of filtering out the wheat from the chaff, and that is what you are going to see in the next 12 to 18 months. You're going to see stuff just flushed out of the system. Deals will get bought up at a lower basis.
Welcome, everyone, to our Hero Capital Show. I'm your host, Tim Mai, and today we have a repeat guest with us, Mr. Mark Shuler. Mark is a very experienced architect, investor for over 35 plus years, and is a big multifamily operators, especially here in the Houston, Texas market. Has over $300 million in assets, over 2,000
600.
units portfolio. 600, you said? Oh, wow. Okay. Yeah, so the bio I'm reading is a bit old, but yes, so over $600 million in assets. And yeah, Mark has really great insight into what's happening here in 2025, 26, 27. And so I'm super excited for Mark to share with us today. And I asked him to not hold anything back. So you guys gonna get to hear the good, the bad, and the ugly and the super ugly. Mark, thank you so much for doing the show with me today.
Yeah, thanks for having me. Just to start this off, I write 4 reports a year. I write 2 that are a snapshot of the current status of the industry. And then I follow that up with a Monte Carlo report where I'll model 10,000, 20,000 simulations of where I think the market's going to go in the next 6 months.
Mm,
I've not done the Monte Carlo report yet, but I did just upload my 2025 year-end report into the chat. So feel free to download that. And here we go. I think the way to frame this debate is to look back at the industry for the last 10 to 12 years. It is no secret that prior to 2, 3 years ago, we were in a very easy credit era. Fed held interest rates artificially low. The bond market seemed to be reacting in kind. Mortgage and credit card debt was historic low levels. And as a consequence, we had a real run up in real estate. Anybody who could walk and gum, all of a sudden, they were a multifamily operator. The problem with that kind of low interest rate environment is it masked a lot of problems that were endemic in the industry. It also
mm,
allowed a lot of people who weren't really good operators to operate because it was just unprecedented demand for what I do, which is near and dear to my heart, multifamily. So prices just kept going up, cap rates kept going down, valuations kept going up. Everybody was making money. We were all fat cats and happy. That was, in hindsight, a historical blip in time. And where we're at now is a reaction to that and what a lot of people are calling a market reset. It's not 2008 and 9 where capital markets worldwide seized up and froze. It's not that at all. There's still plenty of liquidity out there. There are deals that are getting done, but the margins are a lot tighter for one thing. Cap rates have gone up. The cap rates follow interest rates. So if interest rates go up, cap rates are going to follow, and then valuations are going to tumble. For those of you who don't follow this stuff as tightly as I do, just because the Fed does something doesn't mean interest rates on loans are going down. The interest rates are tied to bond rates, and there is often an inverse relationship between what interest rates do and bond rates. And so the first thing I do every morning, I get up and I check the 5 and 10 year, see where it's trading at on that day. For those of you who don't, again, follow this, bond rates are determined by an auction marketplace. And so it just depends what market sentiment is, given the prior days goings-ons, and the bonds will be traded at a rate determined by a marketplace, not by the Federal Reserve. So it's really important that if you're going to be in the real estate game, you understand where bond rates are and where you think they're going to head. I generally think that they're going to trend down and to the right for the balance of this year, but that really depends on the anarchy that's coming out of DC. I don't care what your political persuasion is. The world is looking at the United States right now with abject horror. What's going on here? Bond buyers factor that into their calculus when they buy bonds. So I don't know how to put it any other way. I am neither left nor right. I am agnostic politically because I play with house money. I have to look out for my investors' interests. So I have to read the tea leaves very carefully. When we invade sovereign foreign nations and threaten to invade others, the bond rates are going to react. And look, I'll just give you one other factoid. The United States as a whole is highly overleveraged. We have $37 trillion in national debt. And the only way we don't go bankrupt is by selling bonds. That's the game, folks. And bonds are tied also to the oil market, which is why we're invading sovereign foreign countries, because it's got the largest proven reserves of oil in the world. You can start to see how, at a really macro level, world politics and goings-ons can impact you down on Main Street and how you do deals. So with all of that said, the last 10, 12 years was a relatively stable time in the bond world, and bond rates were reacting favorably to the offerings in the United States. That is not the case anymore. That's why interest rates are higher for multifamily products. The good news is that since in the last 10 months, bond rates have fallen an entire 100 basis points. So last spring, they were trading around 4.6. Today, I think they're probably around 3.65 to 3.7. That's a 5-year. And so they are going in the right direction. Unfortunately, the industry did a lot of deals at these lower bond rates and lower interest rates in the last 5 years. Deals that were put together in 2021, maybe 2019 to 21, all went in with certain assumptions about our deals and how through financial engineering and value add exercises we can improve the NOI and then the value of the asset. And the classic formula is improve it, crank up the NOI, increase the value, do a cash out refi, pay your investors, stabilize it, manage it for 2 or 3 years, sell off, and everybody makes 20 IRR and an APREF. That is no longer the case. Most deals do not pencil at a 20 IRR. Some people are still paying APREFs. If you can find a deal that works, it's great. But it's a much more challenging environment. I'm not saying it's impossible, but you've got to write to the new reality. And that new reality it's not pretty. 2026 is not going to be pretty. A lot of these deals that got put together in 2019, 2020, and 2021, those loans are maturing. What has happened is those operators have not achieved the upside on their deal. And now they are underwater because they haven't created value. They cannot do a refi because the value is not there. What's been going on in the industry for the last 3 years is, I don't know if you people have heard this, but there's this phenomenon called extend and pretend. What loan providers were doing with operators is they were extending loans and waiting for the market to come back down to where it was prior to high interest rates, inflation, tariffs. I think everybody recognizes now that's never going to come back. That we were in a historically low interest rate environment and that the market has reset back to the norm, the historical norm, with interest rates somewhere closer to 4%. These deals that were underwritten assuming a 3.2% or a 3.4% refi, they're cooked, they're done. So I did a chat GPT last week. I was trying to figure out how many deals nationwide are trading below a certain DSCR. That's debt service coverage ratio. And I thought it was low, but the result I got was there were 5,500 deals that ChatGPT estimated that are trading at a 0.75 DSCR, which means they're not even covering the mortgage and expense payments on the deal, and they're going to the hip to support the project on a monthly basis. That is not a sustainable business. Yeah, it's ugly out there. In addition to these macro forces, obviously, in a low interest rate environment, developers get interested. And we had a historical amount of new product delivered to the marketplace. We had 1 million units of product that got delivered in 22 and 23, maybe into 24. And a large percentage of that is still not absorbed into the market yet. That absorption is going to take, in some markets, another 18 months. Not only are you having demand being tempered by the interest rate environment, now you have supply working against you as well. Econ 101 from high school is where supply and demand meet those curves, that's your price. Both of them have shifted so that the price or the rent has dropped. And it is very challenging to fight those forces and try to get the rents you need to be able to get out from underneath this asset. A lot of operators are not going to make it. I hate to say it, but going back to politics, I cannot tell you how many times in my 4,500 doors I've had ICE roll up on my properties and kick them in. I can't even tell you how many times I've gone into units and my tenants have skipped. And so now I'm seeing vacancies spike on my deals, and we're furiously trying to release them. But it's a really challenging time for my demographic profile. I own a lot of doors in Houston, And a lot of my tenants are immigrants, Hispanics, Vietnamese, Cambodians, you name it. They're from all over the world renting units from it. And they're terrified right now. And so now you've got this force driving down just your vacancy and or occupancy and increasing your vacancies. We're like any other operator out there who's got a portfolio. We're struggling to keep up with it all. We're holding our own, but it is a lot more work than it used to be. And I think the conclusion that I can leave people with is you need to be a strong operator in this environment. And lenders are really scrutinizing your operational chops. If you're trying to do third party management and sub all that out, the expense for all this stuff is going up. I didn't even talk about the expense side of the ledger. You've got rising taxes, rising insurance, labor costs going up. Your margins are just getting really squeezed no matter what you're looking at. It is a really challenging inflection point in the industry right now. I anticipate that 2026 is going to be the turning point. And that's where lenders are going to just finally call these notes and put these out to auction. Because here's the other thing. Who's done the vast majority of loans in the last 12 to 15 years? It is not commercial banks. It's private equity. So what private equity, their rationale for the extend and pretend is as long as they kept that asset on the income side of the ledger, they look like kings. They're not taking a loss. They're still paying returns. What they're doing is charging big extension fees to operators, $500, $700, $800,000. When they're making money that way, as soon as they pull them over to the expense side, or even worse, the bad debt side, those private equity firms tank. In addition to a lot of deals that are going underwater, I really sit here and wonder about private equity and how many private equity operators are going to go bankrupt. So this is a huge systemic problem. That said, capitalism is a great thing. It has a way of filtering out the wheat from the chaff, and that is what you are going to see in the next 12 to 18 months. You're going to see stuff just flushed out of the system. Deals will get bought up at a lower basis. They'll operate efficiently again, and life goes on. So the real question is, what side of the fence are you going to be on when this all goes down? And again, I want to emphasize, this is not the world economy collapsing. It's just real estate as a whole is really challenged right now. I can tell you two anecdotal stories. I was just reading a LinkedIn profile about Phoenix. Oh my God, Phoenix is just every kind of wave. I watch it. It's a sand state, right? So they just keep building further and further out. The West Valley of Phoenix, where I play, is nothing but plenty of dirt. Folks go out and buy farmland, throw up Class A products. Every one of those Class A products is offering concession, 3 months free or some shit like that. Phoenix is going to have to grind through it like they did in 2008 and 9, and they'll recalibrate and life will go on. Another anecdote for those of you in office product, the most venerable office operator in Seattle who's been in business since 1958. And at one time, he owned 33% of downtown Seattle. Martin, he is $1 billion in the red because he cannot lease up his product. And it's older product that needs a lot of work. It's a lot of deferred maintenance. And at the age of 85, he's going to go bankrupt. So there's a lot of pain out there right now. And I don't know if you can point your finger at any one thing. I like to frame it as the market is resetting. It was a big party that went on for a lot of years, and the party's come to an end. So,
is this across all asset classes within multifamily A, B, Cs, or is it more problematic in Cs, less so in Bs? What are you thinking? What are you seeing?
I'm seeing it across all classes. Class A product that got built. So, look, typical Class A deal takes 5 years from inception to lease up. When this all started occurring, maybe 3 years ago. At that point, those developers are into the deal, and they have already invested millions of dollars in acquisition and due diligence and design and engineering, and maybe they've gone through entitlement and actually aren't there starting to lay in some infrastructure. The train left the station. All they can do is keep building and for the best. I'm definitely seeing in Class A. Same time, it filters down. You're seeing in B and C because everybody was using the same assumptions. The really ironic thing about this reset is you could do everything absolutely correctly. have the most conservative underwriting model out there and still end up upside down. That's the challenge of where we're at right now. I've been through a few of these, and this one,
Mm,
they're all unique in kind of the forces that come together to real estate's cyclical, right? So we're definitely at the trough, but the forces that get us to the trough each time are a little bit different. And this one has some really unique things going on. So I would
I
say, Tim,
see.
to answer your questions, across all asset classes and all A, B, and C level. Office
Okay.
is definitely in Seattle, it's hurting. I think it's bouncing back in some areas, but with the pandemic, it's easy to figure out. Pandemic, everybody was working out of their house. Offices were generally vacant. The lessees who had those spaces, those leases are up. They're walking away from that space, and there's nobody behind them to lease up the space. So it's challenging.
And you mentioned people who bought 2019, 20, 21. What about people who bought after the interest rates started hiking 22, 23, even into 24?
Yeah.
Are they necessarily on better ground or
It just really depends on the basis they bought it, Tim. We got a couple of deals in 24, and those things are cooking along. But we got them at such a low basis. Other deals, we're struggling that we can't. I know that a couple of deals we own are down by NRG Stadium in Houston. And at what point we were trying to buy that entire block, I'm glad we didn't, because there's a couple of deals there called something in Wilcox. They're right across the street from what we own. Two deals. Those things 3 years ago traded for 120 a door. And I was
mm,
appalled. I was like, that's nuts. Today, they've been thrown back at the lender who is now trying to sell them for 40. So it
wow.
really depends on the basis that you buy these deals for. Now, I also have to look at why are those things trading for such a low level? What went wrong there? Even by today's standards, a two-thirds haircut, there's something far greater going on there than the market. What it is, those are very difficult deals to operate. That is a tough demographic down there. I've had to put armed guards patrolling my properties down there with a gate that raises and lowers with a booth out there with an armed guard in it to let people on and off
Mm,
my property. So it's a very tough neighborhood, and I suspect that has a lot to do with it. But other deals in other neighborhoods, submarkets of Houston, same can be said.
right.
Just buy at the right price. Problem is, you got to figure out what that price is. Is the market still going down? Is it a flat line? Are we going up slightly at this point? Just got to be very careful in your due diligence to figure out where you're at in the market cycle.
What about inventory? New inventory has slowed down a lot in Texas and Houston, and migration is still coming in pretty strong. You don't think that's enough to absorb whatever amount of inventory that will be
Great question.
available
Better
there?
question than you realize. Yeah. So there was just so much product delivered to the
Hmm.
market. I can't emphasize that it was a historically record amount of product that was delivered to the market. It is going to take a while to absorb all that product. Houston has already absorbed all that.
Yep.
And Houston has the largest job growth and one of the larger population growth stories in the country. So that got all absorbed about mid last year. And yeah, we're starting to see some tightening in some submarkets. I can't emphasize ice kicking indoors as a way of emptying out your deals.
I
Now,
see. Okay.
what am I supposed to say?
That's a
Yeah.
tough one. Yeah, for sure. And are you seeing the ICE issue being problematic in Bs and As at all? Or is that more of a
That's
C
more of a
issue?
C class problem for sure.
Yeah.
No question. If
Okay.
you're thinking about doing C class deals, be aware, you got now another macro force that you're fighting. And
Okay.
it's not only
So
the tenants, I'm losing labor. I can't keep people employed. So that's a
yep. So in terms of the opportunities, right? So let's say that the banks will be putting up a lot of these properties for
yeah.
sale. If everything's on sale, is this a big opportunity for
Yeah.
those that may perhaps been sitting on the sideline now can go all in?
Yes, and I know plenty of really strong operators who are aggregating hundreds of millions of dollars, licking their chop. Not only that, so the way I see it, you've got about 18 months here to acquire at the retail level, and then the big boys are going to swoop in. Blackstone, BlackRock, JP Morgan have assembled billions and billions of dollars, and they are going to
Hmm.
buy. It's going to be like BlackRock did after 2008 and 9. They bought tens of thousands of single family units across the country. Personally, I've never understood that strategy because I don't think single family is a commercial property, but they thought it was a good idea. I believe they've sold off a lot of that product since then, but they're going to swoop in and start buying up a lot of multifamily, probably the A class stuff, less riskier product. They have zero interest in the C class. Let's face it, these are dumbass finance guys, and they don't know the first thing about operations. They just make certain assumptions. And, yeah, it's going to work like this. And it's a little harder than that. But that said, they'll probably assemble a team to go out and operate all. They're probably building a big organization right now to go out and just swoop in and buy stuff. A lot of deals are going to be on sale. The basis of those deals will have adjusted downward 30%.
Wow. So you mentioned about banks looking for operators who are seasoned, experienced. Is there like a certain guideline to what that means?
Yeah. You've got to probably have a few deals under your belt. It really helps if you're vertically integrated. If you start shopping out every function of a deal, you're probably going down to the C level in terms of banks looking at you as a serious contender on a competitive deal. So a lot of these deals are going to go out brokered, hit the market, and it's going to be a best and final. So it's going to be an auction format. The strongest operators are always going to get first bite of the apple, for sure. I can't emphasize right now, the entire industry is looking for strong operators. They don't want people who are, I just hate to say it, newbies, because we got here because of it. They want to make sure that they don't want to take these deals back a second time. So they want to make sure whoever gets them can get them, operate them profitably, get the operations under control. I have 200 people on the payroll, and 60% are on the leasing side and 40% are on the maintenance and unit turn side. We control our supply chain. We got direct vendor relationships to China and India. Tariff withstanding, we're still doing that. I've got a 20,000 square foot warehouse in Houston where I just store material. And I've got drivers that are running around picking that up for me and hauling it to our job sites. That's a strong operator. And we built our organization specifically to do that. And why? Because we control the expense side of our ledger, which means I'm not guessing at what my labor is going to cost 2 weeks from now. I know what it's going to cost because I have them on a W-2. I face other problems because I can't keep my labor. They keep labor at that point. If they get 50 cents an hour more, they're gone. We're having a hard time retaining labor. And then a lot of them are immigrants and Hispanics. So now we're doing H-1B visas and we're importing labor from Mexico across the border to come work on our projects. It's legal.
Wow.
And those guys, they're just happy to have a job in a safe environment. They work at $12 an hour and they're happy. So you do what you have to do in order to operate. You just got to be hyper fixated on your operation. If you can do that, you're going to really elevate your status in the eyes of lenders.
I see. Now, I know, Mark, you also have another venture that you are into right now. Are you still going to be a buyer in multifamily in 2026 and 27 here?
I don't know. Boy, I've thought about that a lot in the last 2 weeks. I honestly don't know, Tim. Look, I just turned 66. I'm on the downward slope of my life, and how much more of this nonsense do I want to put up with? Because it's a hard way to earn a living. That said, I've always enjoyed the game. And but my new venture is a lot of fun. I'm really, for the first time in a decade, I'm having fun. So
that's awesome.
The problem is when you're a deal junkie, you got to get your fix. So it's hard.
That's awesome. All right, Mark, really appreciate you. Thank you so much for coming on the show with us today. Yeah, you've been a wealth of information. Great conversation. This has been one of the best conversations we had on the show, so it was good.